All right. I am here with Alex Frederick, Senior Analyst of Emerging Technologies with Pitchbook. How you doing, Alex?
Doing great. How are you doing?
Doing well. I always look forward every quarter to the reports you guys put out on what's happening within the funding environment around food tech in particular. You also do ag tech, and you guys just released your Q4 update on what's happening in terms of investing around food tech. And it didn't paint necessarily a great picture in terms of overall numbers. It looked like numbers were down year over year. Tell us a little bit at a high level what the numbers told us.
Sure. We're seeing deal values and deal counts both continue to trend downwards. Hoping to see a plateau here over the next quarter or two, or not plateau, a nadir, but definitely seeing things continue to decelerate. Deal values annually were 9.2 billion, and deal count was roughly around 1,400 deals. And quarterly, we're seeing deal values totaled 1.7 billion and 279 deals. So we're seeing deal values quarterly down about 40% and annually almost 60%. So fairly significant decline over prior years.
And we can dive into the specific subsectors that I think that drove the numbers down. But can you tell me, it seems like overall venture investing has continued to decelerate. So this is somewhat in line with an overall downturn around investing.
Definitely. I would say it's helpful to parse out food tech specific drivers and overall specific drivers, but definitely some macroeconomic challenges that have been going on for the past 2 years. And we're seeing high interest rates, closed IPO window that are factors continuing to constrain VC activity, and then also. We've seen annual food price inflation. It's slowed this year. Most recent numbers, 2.2%. But as we know, inflation is cumulative, and food prices are at record highs for consumers, and that's definitely going to challenge some of these more innovative startup CPG products that are attempting to enter the market at a price premium.
When I look back a couple of years, what was driving it seems like a lot of the food tech investment were fairly big rounds into things like 10-minute or hyper fast grocery delivery. There was also a significant investment into alternative proteins. We saw some fairly big late round investments into the likes of Eat Just, et cetera. Upside. Those types of investments seems like they've gone away, right? Is that part of the deceleration trend with specifically when we're specifically talking about food tech?
Yeah, so the whole e-commerce space, which for us includes online grocery as well as restaurant delivery, that's down just in 1 year, 67% in terms of dollars. And looking back to the peak in 2021, down 87% since that point. So major deceleration in e-commerce. I would say a lot of that has to do with this investor shift from growth to profitability and positive unit economics. We're also seeing technology in restaurants and retail also over the past year down 71, 72%, 85% over the past 2 years. So major deceleration in investment in those sectors. Alt protein, also a space that's seeing deceleration. And I would say similar drivers here. We're seeing investors really shift their focus from growth to focusing on companies that are driving positive unit economics, or at least have a path to that end. I would say with alt proteins in general, and more so when you're looking at more of the novel protein technologies like cultivated and fermented, you're dealing with technologies that have high capex, long time horizons, long exit timeframes, and operating in the CPG food and beverage space, they're operating with relatively low margins. So they're really balancing this delicate line of trying to be profitable in this very expensive, capital-intensive segment. So challenging, and I think investors are perhaps coming to terms with that.
Can we talk a little bit more about the alternative protein space? When I look at that, typically like a good food institute has broken it down into like 3, sometimes 4 different stools or legs of the stool. You have your plant-based, you have your precision fermentation, you have cultivated meat. They've looked at some other emerging technologies like molecular farming, for example. But it seems like plant-based meats, for example, the appetite for that has really gone downwards from an investment perspective. Cultivated meat, it seems like it's a moonshot still concept. And so maybe the long time horizon, as you referred to, is worrying investors. Precision seems like it's maybe continued to see interest, but you're saying that interest has gone down as well.
Actually, out of all of the alt protein segments you mentioned, fermented protein has actually increased in 2023 year over year. It's up. Deal value is up 27%, and that's combining all of the fermentation technologies. But there are I would say it's fair to put precision fermentation into that moonshot category. It's still fairly high tech, capital intensive technology.
Got it. It requires a lot of big fermentation tanks, and a lot of the infrastructure there seems like it hasn't fully been developed for scale. Is that picks and shovels types of investment? So the infrastructure to build these next gen alternative proteins, is that a category that's become more in line with what maybe investors want to invest in? Because we need to kind of get there before we take the next step.
Right, we are seeing a growth of picks and shovels and the whole ecosystem. So companies that are popping up and focusing on growth serum and alternatives to the growth serum. I guess that would be in the cultivated space, but we're seeing more. Perhaps this is not appearing in the VC space, but seeing more fermentation vessel companies that are focusing their attention to cultivated and fermented. So just more attention and kind of a growth of stakeholders and focus on building out all of the inputs and infrastructure that you would need to grow that industry.
Shifting to restaurant tech, obviously that space has been turned upside down over the last 4 years due to the pandemic. It seemed like there was a lot of activity in startups around the digital transformation, allowing restaurants to have more kind of online order flows. And then also there is ghost kitchens, which is related, but a little bit different in terms of virtual restaurants and kind of the centralized kitchen concepts. Talk a little bit about what you're seeing there, because you said overall the category has gone down, but it seems to me I still see a lot of startups building digital platforms in the restaurant space.
Definitely still seeing platforms. Perhaps, actually, I don't have any good examples for the restaurant space, but online grocery space seeing more specialized approaches. So either more local or sustainable alternatives. But in the restaurant space, definitely seeing technology innovation there, advancements. Seeing companies, when you're looking at drive-through technology, companies implementing generative AI tools and other restaurant management software to optimize and streamline restaurant practices.
You did talk about ghost kitchens as one area that saw a little bit of growth, but it seems like maybe that was largely driven by the Wonder $100 million round. So overall, we saw an increase, but it seems like, as you also said in the report, ghost kitchens are kind of reevaluating and rebuilding their models to meet the reality of where they are today.
Yeah, that's absolutely correct. The one of the largest deals of the quarter was Wonder's $100 million deal, but there were but we've seen a significant deceleration in investment in ghost kitchens overall, and we're also seeing reports of a number of the larger players who received in the $100 million or more total venture funding. We're seeing many of those companies actually pull out of markets and reevaluate their go-to-market strategy.
Yeah, so like Reef and Travis Kalanick's ghost kitchens or cloud kitchens, they seem like they've had to kind of revisit their models a little bit. And overall, the industry seems like it's revisited the model a little bit, because it does seem like that space has more real estate kind of dynamics than it does maybe kind of technology dynamics, right? Because it was the original vision, like Travis Kalanick's was a heavy investment in real estate.
Right, and it seems like many of these companies are making more of a real estate play, uh, but it does seem like there's a management aspect that these companies perhaps are struggling um, to optimize or execute on. Hearing reports of some of these companies that are seeing high turnover rates and are really challenged to keep these virtual restaurant brands on premise.
It seems like a broader category in tech that's been immune pretty much to the crosswinds and or the I guess the headwinds in funding that's kind of driven a lot of the deals totals down is AI. So we've just seen massive investments in those as you know people got excited after the reveal of OpenAI in late 2022. It does seem like a lot. I've seen a lot of startups in the restaurant, or excuse me, in the broader food tech space start to highlight angles of their business that where AI is a part of it, or they've tried to maybe rebrand themselves as an AI company. Some of that seems like an obvious attempt to kind of tap into the strong interest there. But what are you seeing with the kind of the vertical focus of AI around food? Are you seeing that area seeing investment?
I haven't specifically looked at that angle of it or AI investment, that overlap of AI and food tech. I think part of the challenge is it's such a buzzy keyword. It seems
Yep.
like so many companies out there say that AI is baked into their model, and it's difficult to assess how much is actually AI or just could be simply rudimentary machine learning algorithms that are referred to as AI. So I would say that that term has become overly buzzy in venture overall. But there definitely is some exciting concepts with generative AI, but I'm not seeing too many companies that are fully baking that in and deploying generative AI in their business models.
Yeah, it reminds me of the early days of the cloud computing revolution when everyone started to kind of rebrand their companies as cloud computing technologies. So it's an interesting parallel. Turning to just real quickly, consumer products, that's a hard space for, I think, for venture investing. I mean, it just seems like the dynamics are so different from B2B. But you know, you mentioned a couple of companies in your report. One of them being Cold Snap, for example, that has an interesting seeming growth trajectory, making, for example, a countertop kitchen ice cream maker. You know, Mill is another one that might be interesting. They have an interesting founder group with the guys from Nest. Talk about like the consumer space, particularly around food. Are you seeing anything interesting there? Is that continue to be a difficult place for venture?
I would say I haven't seen any strong positive trends there. I think there are occasionally interesting models or concepts, technologies, devices that are coming out in that space, but it seems like I'm hearing of more companies that are struggling in that space and perhaps folding or shutting operations than I'm seeing companies uh, that are success stories.
Yeah, I wrote a story yesterday about a company out of Europe that actually had backing from a large grocery company. There's actually kind of a spin out called uh, Delica, which they made this coffee bee platform for essentially a compostable coffee pod. And they were getting lots of traction in Germany, Switzerland, and France. And I'd wondered how they're going to enter the U.S. market because you know there's the behemoth of Keurig. Well, as it turns out, Keurig decided to do a deal with them to actually use their technology to create a next completely reinvented their platform. So Keurig's coming out with a new coffee machine that has fully compostable coffee pods. So it seems like maybe the way to market there for startups is to partner with big brands that already have tens of millions of customers because it is hard oftentimes to break into the consumer market. But if you have a technology that an existing player can use, that might be a good entry point.
I think that's a really interesting idea. I had heard about that new alternative to K cups, which I think is very interesting. It seems like that's one of the main criticisms against the Keurig model is the waste that the K cups produce. So that's really exciting that they're able to partner and develop this uh, K cup free new pod, and that is interesting. I think that highlights a trend that we are starting to see as many of these companies are struggling to raise funding in the current environment, they're looking for either non-dilutive sources of capital or just alternative sources of capital or tools to help them raise. And I think one of those vehicles is strategic partnerships with corporate partners.
Well, as always, Alex, I enjoy reading your work. The reports are really valuable to give us an analysis for what's going on in funding in the food tech sector. So keep up the good work. You guys, PitchBook, you put these reports out every quarter, right? So where can people find this latest report?
Sure. Just go to the Pitchbook platform. You'll see it right there in our research center.
Awesome. Thanks, Alex.
Cool. Thank you so much.
Don't hang up. Don't hang up.